Yes, see, typically the documentation follows. See, in a venture capital investment, typically your early stage rounds, the first one or two or three, may not result in promoters losing majority. If promoters are not losing majority, they are effectively in control of the company. At least under law, they are in control of the company. What investors seek to do in deals where investors as a group are a minority as compared to the promoter would be to have very strong protections in terms of ensuring that the value of their shareholding is not diluted, in terms of ensuring that they have some basic rights in terms of I would say ensure that they have rights where the promoters are taking serious actions in the company which may affect the value of their shares. And typically that is what your investment documentation is. In any transaction of financial transaction, whether it is debt or equity, the moment you put in money, you become the weaker party, and until you put in the money, you are the stronger party. So you try to get in as much as you can in the documentation as a minority shareholder, because you are subscribing to shares at a premium. It's a financial transaction as far as you're concerned. You want to protect the risk profile of your investment. As the company grows, as the number of investors or the size of their investment in the company increases, then you're looking at a situation where investors are substantially in control of the company. And if that is, the shareholding is maybe in the controlling range or higher, and then it becomes a completely different conversation in terms of governance, in terms of stakeholding in the company, and how management is looked at. Typically, you want the company to have reached a certain stage in its growth before it is widely held or controlled by investors. And that is something that I think you as a company have to determine when is the right time for you to enter a stage where you are more running the company professionally. You are looking at a wide base of shareholding, a wide board of directors, and you typically would like to be in a certain growth stage, or even beyond that when you reach that level, because the agility that is available to management in early stage companies would not be available to you. But there are certain, of course, there are great advantages of having a wide base of shareholders, a wide board of directors, and so a robust corporate governance. At any point of time, the person with the, at least commercially, the person with the largest amount of shareholding in the company among the investors would call the shots. It wouldn't have anything to do with who is the last person in. Yes, the last person in tends to, commercially, yes, it is likely that the last person in has brought in a lot of money, but that may not necessarily make him the largest shareholder among the investors. Yes, and the comfort with the largest investor in the company is something that is very important for any other investor. And many a time, investors are betting on the largest investor as much as they're betting on you. So they would follow the largest investor in the company. If they intend to be the largest investor, then you're looking at a different scenario where the previous investors are going to be take a back seat going forward, and that is going to be a sort of that is a huge change as far as you're concerned. If your second investor is much larger than your first, it's going to be very likely the person who's going to drive your company as an investor for a reasonable point of time going forward. And until his shareholding is exceeded, you're looking at him representing the group of investors. Yeah. So if you so what I was saying is, if you see how venture capital works, typically a venture capital investor, a large venture capital investor would like to claw into a certain percentage of your shareholding, and typically the better your company does, more that investor would want to claw into your shareholding. But as a private limited company, your existing investors have a huge advantage in terms of not only diligencing your company, but also closing deals with your company effectively. So at some point of time in the growth of your company, you will have to bet on a certain investor more than everybody else to take you forward. This may change, but it's very likely that you will have one very large venture capital investor in your company who is driving the company, apart from the management. Yeah, in terms of potentially controlling your company in terms of shareholding or having a very substantial number of shares in a company. And it is not just a question of veto; it becomes a much wider conversation, because if investors as a group control your company, you can be fired. So you are wearing two hats, as an employee and as a shareholder. investors typically agree between themselves that there has to be one person who's leading the conversation. If you are not in such a, at least in the first few rounds of investment, there has to be a certain understanding among your investors. Otherwise, if you have investors who don't like each other investing in your company, you have a problem on your hands, and they should not ideally be agreeing to invest together. So it's very important that the people who are in your company as shareholders have a certain chemistry, at least in the early stage, because otherwise you're going to complicate things for yourself as well as the people who have invested in you.